Jai Jinendra and Jai Shri Krishna. नवनाथ असोसिएशनના પ્રમુખ શ્રી દિલીપભાઈ મિઠાની, વડીલ શ્રી ભૂપેન્દ્રભાઈ શાહ, નવનાથ ભગીની સમાજના પ્રમુખ શ્રીમતી રેણુબેન મહેતા, our wonderful Zoom team, and everyone joining on Zoom today. My name is Sushma Shah, and I am the treasurer of Bhagini Samaj. And I would like to welcome you all on behalf of Bhagini Samaj. Navnath Bhagini Samaj have organized a very interesting financial event for today. Although this event is relevant to everyone, Bhagini would like to encourage women to pay attention to such financial matters. We are able to look after our children, cook, pray, attend functions, and run the household. As women, we have so much resilience, knowledge, and drive. These are transferable skills. Why we cannot use them in finance too? We can do it. NBBS Secretary Punimaben Mehta will now introduce our speaker for today. Jai Jinendra.
Sarvane Jai Jinendra and Jai Shri Krishna. My name is Purnima Mehta, and I am secretary to the Navnath Bhagini Samaj. Dipesh Bhai is a company director and a wealth manager at Oakdale Financial Services Limited. He has a wealth of knowledge and experience of advising clients on their financial planning, including inheritance tax planning, investment planning, retirement planning, and protection planning to ensure that you are maximizing your financial planning. Dipesh Bhai is a regular presenter on various Zoom webinars to many different communities. He enjoys helping his clients with their financial planning and ensuring that they have a peace of mind. On this occasion, a donation of £526 has been made by Dipesh Bhai to Navnath Bhagini Samaj. Thank you for that, Dipesh Bhai. Questions? If you have any questions, please put them on the chat and we will try and address them at the end of Dipesh Bhai's talk. Over to you, Dipesh Bhai.
Jai Jinendra, Jai Shri Krishna. Thank you, Purnima Ben, and the rest of the Bhagini and Navnath community for organizing today's presentation. Today's presentation is entitled Inheritance Tax Inherently Unfair. So what I'm going to do now is I'm going to share the slides and run through the presentation. The presentation will help you to understand more about inheritance tax planning and what you can do to ensure that more of this money stays within your family. So a little bit of background about myself. I've been advising clients since 2005, so many years of industry experience, certainly helping lots of clients with different types of financial planning. The company, Oakdale Financial Services, I started it in 2011. The company has been around for more than 10 years. And my company, Oakdale Financial Services, is a partner practice of St. James's Place Wealth Management. St. James's Place is a FTSE 100 company. They started in 1991, and St. James's Place is responsible for looking after client funds, £129.3 billion that's been looked after by St. James's Place Wealth Management. We specialize in trusted face-to-face advice, so it's really about making sure we understand your situation and we're advising you in the correct way. Through St. James's Place, we have access to a wide range of products and services which will help with your financial planning. And the key thing is my advice is backed up by the St. James's Place Advice Guarantee. So what that means is if the advice I've given is found to be incorrect, then St. James's Place will put you back in the correct position. So it gives you that peace of mind. So really, we'll start off with the aim of the presentation today. The aim is to help you to have an understanding of inheritance tax planning and the steps that can be taken to help to mitigate the financial impact and ensure that more of this money stays within your family and is able to pass from generation to generation. The key objectives that we'll be looking to cover at today's presentation. So we'll have a look at some of the concerns that people have in relation to inheritance tax planning and financial planning in general. So a lot of these concerns will be fairly familiar type of concerns to you. They will apply to your circumstances. And these are the ones that we come across quite regularly when we're having meetings, discussions, webinars, etc. We'll have a look at some initial planning ideas, what you can do there. We'll introduce nil rate bands, what they are, how much they are, how they work, etc. We'll look at the assets above £2 million, what happens in that situation. We'll have a look at a situation where you could have inheritance tax at 64%. We'll cover off gifting exemptions, the exemptions that you're able to make use of to maximize your planning. We'll have a look at the 7-year rule and how taper relief works on gifts that you've made. We'll have a look at wills and lasting power of attorney, important to have those in place. We will cover different types of trust plans, trust-based planning, and how these trusts can be helped with your overall financial planning. Of course, we'll have a look at covering any liability with the whole of life policies. There are other types of investments that we'll cover. So we'll cover enterprise investment schemes, business relief, and we'll have a look at main residence property planning. So these are the concerns that we come across on a regular basis. So the first one relates to the amount of inheritance tax, including the cost to the estate and the ability to pass on assets to future generations. So of course, we'd all like to be able to leave money to the future generations, and we're concerned how much the tax will erode, how much we can leave them. What about the fact that we have to pay 40% tax at the point of death when we've already been paying tax during our lifetime? So if you look at during lifetime, there's various taxes that we pay. So you pay income tax on any income, you pay capital gains tax on any gains that you make on assets, you pay national insurance, you pay VAT. And if you look at it, if you add up all of those taxes, it's quite a lot of money that goes in tax from the beginning until the end. You may wish to give away money, but at the same time, one of the concerns that a lot of people mention to us is, well, if we give the money away, what happens? We're going to lose control over the money. So you may wish to retain an element of control, because I think that's quite important as well. We need to think about what will happen if your circumstances change in the future, i.e. you need access to the money, your situation, your circumstances change. Now, we have to be careful. When you give the money away, it's not always definitely going to be available if you need it back. So you've got to be careful when you're giving money away, how much you give away, when you should give it away, and you should also make sure that you've got enough just for yourself, just in case circumstances are totally unexpected. So we'll have a look at the 7 years is too long. So we know that once you make the gift, you have to survive 7 years. But unfortunately, it might not always be possible to survive 7 years after making the gift. So there are some particular factors that we need to consider. So for example, your age. What about your health as well? And if your health is not very good, then it might be less likely or more difficult for you to survive the 7 years. A lot of people will also say that there's not enough time to manage the wealth, manage their inheritance tax planning, as well as keeping up to date with changes. So there's various changes that take place. There were changes, well, in the recent budget, Rishi Sunak, the Chancellor, has said that there's going to be no change to the inheritance tax thresholds, which we'll touch upon a little bit later on. And then we're not sure if what you're doing is the correct thing. Are you planning it in the most efficient way? So there's a whole range of factors we need to consider when looking at your inheritance tax planning. So we'll start off with some initial planning ideas. So the first one is ensuring you make use of your ICE allowance. So every year, you're advised to make use of ICE allowances. So two main types of ISAs. One is your cash ISA, where the rates of return are very, very, very low. You've got the problem of inflation eroding away the value of your cash ISA. So the value of your money is getting eroded over a period of time. And you have investment ISAs as well. Now, with ISAs, most of the ISAs are not going to be inheritance tax friendly. So a lot of times you're told ISAs are great from an income tax point of view, capital gains tax point of view, correct. But when we're looking at from a inheritance tax point of view, ISAs will normally become part of the estate and therefore be liable to inheritance tax at 40%. So we need to think about whether that's going to be the best use of funds within the ISA. So for example, the current base rate is very, very low, 0.25% is the base rate. So therefore, returns on savings accounts is not going to be very, very high. We should certainly consider maximizing contributions to your pensions. Now, every year, subject to having earnings, you can put in a maximum of £40,000. So pensions are really attractive in the sense that if you're a basic rate taxpayer, you put in £8,000 into your pension, then the government will automatically top it up and make it up to £10,000. If you're a higher rate taxpayer, you put in 8, the government will top it up to 10, and you'll also be able to claim through your self-assessment an additional £2,000 back. So this means that the cost of the pension contribution is costing you £6,000, but on the other side, you'll have £10,000 in your pension. Now, pensions are great purely because they're free from income tax, they're free from capital gains tax, and they're free from inheritance tax as well. And with the recent changes that have come in, pensions are now more attractive, i.e. you can pass it from generation to generation, especially if you've got other income, other assets, and you're not reliant on that pension. So that certainly pensions are very interesting. There have been changes to some final salary schemes as well. So as part of inheritance tax planning, it may be possible to look at those if you've got other assets and you're not relying on those final salary pensions. We're able to go back. So with pensions, you have to use the current tax year first. So 21-22 is the current tax year. You can go back to 18-19, 19-20, and 20/2021. So that allows you to get significant amounts of money out of your estate and into your pension, providing you have the earnings. If you have a limited company, then there is opportunities to make use of pension plannings. You should consider making contributions to junior ISA for your children or your grandchildren. Now, again, there's two different types of ISAs that you can have. With junior ISAs, you're going to have the cash ISA version, where there's not going to be much growth. It's just a very low interest rate, or you can have the investment junior ISA. Now, one of the things we'd recommend is if the money is going to stay in a junior ISA for a long period of time, then maybe a cash junior ISA may not be the best use of that money because the cash is not growing, it's getting eroded by inflation. So the longer the time, the more sense it makes to invest that money. You should certainly try and make use of your capital gains tax allowance. So every year you've got an allowance, each person has their own individual allowance. Now, what they should be doing is, for example, what you can do is you can split assets between husband and wife so that you can utilize 2 lots of allowances. You can consider selling assets at the end of the tax year, i.e. just before the 5th of April, and you could sell some more assets just after the 6th of April in the beginning of the tax year. So it allows you to sell a large amount of assets. It allows you to utilize more of the allowances, and therefore ensures that you save on capital gains tax. The other thing you can do is you can defer the sale of the asset until your tax position changes. So if your tax position is going to change from a high rate taxpayer to a basic rate taxpayer, it would make sense to wait until your tax position changes. Or if you're going from a basic rate to a nil rate taxpayer, then of course it would make sense to wait a little bit longer, just purely because that will help you from a capital gains tax point of view. We should consider making use of small gifts or gifts from income to reduce inheritance tax, and I'll go into these a little bit more. And using the annual gift allowance for this year and next, which I'll touch upon on the next slides. So we'll have a look at the nil rate band. So currently, the nil rate band is £325,000 for an individual, and for a couple, it's £650,000. Now, what's happened in recent times, Rishi Sunak, the Chancellor, has frozen the allowances, the current allowances that you can see on the screen, 325 for an individual or 650 for a couple. Now, these allowances have been frozen until 2026. So what that effectively means is that as the asset prices continue to increase, that means more and more people will get caught because their assets are pushing above the allowances. We'll also discuss the main residence nil rate ban. So from the 6th of April 2020, the full allowance will apply as follows. So for an individual, they get an additional £175,000. So that brings their allowance to £500,000. 325 plus £175,000. And for a couple, it's going to be double this, i.e. £1 million. Now, with asset prices continuing to increase the way they have done, more and more people are going to get caught by inheritance tax. So previously, inheritance tax used to be it used to apply to very wealthy people. Now, I would say that it's a tax that applies to a lot of normal, ordinary people, majority of people. You have one property, maybe one buy-to-let, a little bit of cash. It doesn't take long to go over those limits. So it applies to one property that's been your main residence at some point, but executors are able to nominate, so where you've had more than one property. It's passed on death to direct descendants, and this will include a child, including step, adopted, or fostered child of the deceased and their lineal descendants. It is fully transferable, so both the nil rate band and the main residence nil rate band are fully transferable allowances. So what this means is if the first person has already passed away, and then their allowances will, assuming everything passed over to their spouse, then everything, the spouse will have the full allowances available to them. So that's useful where one of the spouse has already passed away. And when we talk about individuals, we're talking about single people or divorced people. And in terms of couples, we're talking married couples or where somebody has passed away. So just to summarize, in the current tax year, the allowances are as follows. For an individual, £500,000, and for a couple, it's £1 million. We will now have a look at what happens where you've got assets over £2 million. So this is where the government has introduced some additional rules, some additional restrictions, which affect you where your allowances, where your total asset value is more than £2 million. So what happens here is so the main residence nil rate band will be reduced by £1 for every £2 that your assets are above £2 million. This means that if your estate is worth 2.2 million, i.e. £200,000 above the £2 million value, then you will lose £100,000 of main residence nil rate band. So this will bring the £1 million down to £900,000. And as a result of this, there will be an increased tax of £40,000. Now, what happens is when your assets get to 2.7 million, then you lose the whole £350,000 main residence nil rate band. In terms of tax, this is going to cost an extra £140,000. So if you're far away from the 2 million, you might think, well, you don't need to worry because there's a long time. You have to still consider that based on average life expectancy asset prices will tend to carry on increasing. So more and more people will continue to have inheritance tax problems. So we need to pay attention, even if you're not quite at the £2 million stage right now, because more and more people will get caught by this. And if you're already above the £2 million, then what we need to look at is some type of planning where we can try and bring your assets back as close to this £2 million as possible to allow you to recover some of this main residence nil rate band, which would otherwise be lost on assets over £2 million. Now we're going to have a look at this situation. So this is so in this scenario, what we've got is we're looking at the scenario where the question is, will your family pay inheritance tax at 64% in just 3 generations? So I'm going to explain and demonstrate that this is a very, it's not an unusual scenario. It's actually a very, very realistic scenario. So in this case, we've got assets. So the couple, we'll call them the first generation or the grandparents. They've got £1 million. They've got assets £1 million, and they've got, so that uses up their allowances, and they've got another £1 million. So total value of assets is £2 million. We're talking about the £1 million that's over the allowance, which is going to be subject. So when this first generation pass away, this is going to be subject to inheritance tax 40%, which means that £400,000 has been wiped out. Now, the amount of money that will go to the second generation, i.e. Their children, is going to be £600,000. Now, in this scenario, if the second generation pass away just 5 years after the first generation passed away, so anytime after 5 years, then again, there's going to be tax to pay. So this on this £600,000, you're now paying some more tax. So you're paying tax on tax, which will bring the original £1 million down to £240,000. Now this means that the government will be the largest beneficiary, i.e. the government is going to benefit from 64% or £640,000, which is going in tax. Now, the third generation will only receive £360,000. So this scenario is showing you that it's really important to make sure that you start thinking about this planning, start thinking as early as possible so that we can mitigate the impact of this. 64% is a huge amount of money to pay to the taxman, which could be avoided with good planning. So here we're now going to have a look at various gifting exemptions. So some of these you may already be familiar with, you may have come across them. Now the numbers are actually quite small because these numbers were set up a long time ago by the government. They haven't really increased these numbers. So the value is limited, but nonetheless, where we've got allowances, we should try and make the maximum use of these allowances and maximize your financial planning. So you're allowed to give away small gifts of £250 to as many people as you like. The great thing is you will save £100 immediately from inheritance tax. You're able to utilize your annual gift exemption. So each person who's making the gift has an allowance of £3,000. So husband and wife in the current tax year could give away £6,000 between them. You also have the option to go back a previous year and again use £3,000 each. So that's another £6,000. So by making use of this annual gift exemption, you can get £6,000 or £12,000 out very quickly, certainly if you haven't used the allowance for last year, and also, of course, you've got the allowance for this year. So again, it's worth using it because what we're trying to do is we're trying to give away some of the assets, reduce the value of your estate, make use of some of these exemptions where they're immediately exempt. So again, important to use them where available. You can make gifts in terms of weddings. So for example, you can make a wedding gift if your son or your daughter is getting married or your grandchild is getting married, then you're able to utilize this exemption. Now, usually it has to be done before the civil ceremony takes place. The gifts have to be made in respect of the wedding. Now, there is also another exemption that you can consider, which is not really used that regularly or that often by a lot of clients. It's what's called the regular gifts from income. So this is where you have surplus income. The great thing is you can give away your surplus income. As long as it's not your capital and it's your income, i.e. money that you've built up from money that you've not spent, i.e. money's come in, you've minus your expenditure and tax, and then what you're left with is going to be your surplus income. Now, the revenue are totally happy with you if you give away your surplus income, because this doesn't have any impact on your standard of living. Whereas if you give away capital, it could have an impact on your standard of living. So the key thing is when you're giving away your income as the money comes in, then that's going to be immediately exempt. And the great thing with this exemption is there's no upper limit. So whatever surplus income you have every single month, you can give it away and benefit from it being outside of your estate. So we think this is a really good exemption that people should be considering to use where they've got this surplus income. Whereas with the capital, the money will take 7 years to get it outside of your estate. So it's better to try and give it away as it arises if you don't need it. You can, of course, consider making gifts to charitable organizations such as Navnat, and of course important to support the community. So there will be some tax benefits there as well from your point of view, and it will help the community to do various good things that they do with their fundraising. So just really a summary from an estate planning point of view. These are the numbers that we've covered so far. £3,000 single allowance, £6,000 husband and wife. You can make use of the carry forward, £12,000. And you could consider where you've got these allowances, you could consider putting money into junior ISA contributions for the children, or you could consider making contributions for grandchildren or children into a pension. And the great thing is when you put in 2,880 as a contribution, the government will top it up with tax relief and bring the total amount to 3,600. So from your point of view, it allows you to utilize your exemptions. It allows the money to come out from your estate. It allows the children, the grandchildren to start building up this money. And if the money's been invested over a long period of time, they will benefit from growth rates, they will benefit from compounding. And the longer you leave that money to invest, you leave it to grow, the better the return will be longer in the future. We'll now have a look at the 7-year rule where we're looking at taper relief. Now, what happens is with taper relief applies once you've given away the first £325,000. So the first £325,000, if you give it away, i.e. the nil rate band, and you passed away within the 7 years, there wouldn't be any relief on that money. That would just be considered as a failed gift where you've utilized your nil rate band. So for example, you make a gift of £100,000, you don't survive 7 years, that will reduce your nil rate band by £100,000. So the available nil rate band available to your spouse will be £225,000. So in regards to this 7-year rule, taper relief, this applies after you've given away the 325. Now, what these additional gifts above the £325,000, in the first 3 years, there's not going to be any benefit. There's no benefit of taper relief. So that means if you're passing away within the first 3 years, you'd be liable for the full inheritance tax at 40%. The benefit starts coming in after 3 years. So if you were to pass away between 3 and 4 years after giving the gift, then the taper relief will come down to 32%. The next year, i.e. between 4 and 5 years, it comes down to 24%. Between 5 and 6 years, you see it's dropping to 16%. And then if you were to survive more than 7 years from making the gift, then there's going to be zero inheritance tax. That's where you're saving the full amount of inheritance tax. So what this is showing us is that it makes sense to try and give away these gifts as soon as possible, purely because it means that there's a better chance of surviving this time period. So we should certainly consider giving assets away during our lifetime. Certainly, if you don't need it, but you've got to be careful how much you give away, when you give it away. You've got to think about if your circumstances change, your health changes, and it's really important that all of this is planned as well as possible. You should certainly consider arranging your estate tax efficiently. So we're talking about having wills in place. Important to have wills. Everyone knows the importance of having a will, but unfortunately, it's never really on anyone's top list of priorities. There's lots of things happening, various things to consider, but certainly you should get it. There's no disadvantage, and it gives you peace of mind and ensures that your money, your assets will pass in the right direction to your family members that you want to receive this money. So absolutely vital. If you haven't got a will, certainly something that you should consider. What I would also add is if you have already got a will, maybe you've done it a long time ago, 5, 10, 15, 20 years ago, it's worth reviewing it. There may have been some changes that could be incorporated, or the wills could be made more efficiently. So again, I would recommend that the wills are reviewed. Once you've got your wills done, you can relax. You've got that peace of mind that at least you've got this important document done. And then moving on to lasting power of attorney. So there's two main types, and this really comes into play if you were to lose mental capacity due to loss of mental capability due to accident or illness. And there's two main types of power of attorney. One is health and welfare to deal with medication, treatment, that sort of thing. And the other one is property and financial to deal with assets, bank accounts. And I would normally recommend that most people should get both of them done, just to give you protection, peace of mind of whatever happens. So again, definitely worth doing those. And we'll also have a look at covering any liability with whole of life insurance. So previously, I've mentioned giving away some of the assets where possible, but it may not always be possible to give away the assets because some of the assets may have some very heavy gains. And therefore, if you were to give the asset away, sell it, transfer it, you're going to trigger a capital gains tax liability. You might also rely on the security of the asset or the income that it provides. And therefore, you might not wish to give the asset away because that would mean you'd have to give away the income as well. So there is another solution where we could look at using life insurance as a way to cover the inheritance tax liability. Now, the cost of protection does not need to be expensive. So, for example, this is based on a joint life, second death, whole of life policy, which covers both people, and it pays out when the second person passes away, and that's when the inheritance tax is going to be due. Now, in this example, we're working on a figure of £100,000 liability. So what we've got here is, let's say both applicants are age 45. They are both healthy, they're non-smokers. Then what the premiums per month will be £97.12 per month. Now, if you carried on paying this premium, you would have to live to the age of 130 before you've paid in £100,000. So it works great from a life expectancy point of view. It works great from the point that you know how long you need to live before you've paid in more than the policy pays. And also the good thing is with this whole of life policy, what you're doing is you're using you're putting this planning in place to allow you to generate the lump sum to pay the inheritance tax. The other thing to consider is sometimes in some scenarios, you may also wish to leave some extra money to the children. So let's say in this scenario, you've got 2 children, your tax liability is 100,000, and you want to leave them an extra £50,000 each. Then a whole of life could be used as a way to provide additional funds for your children in the future. The money that is generated by the life policy is tax-free. It goes into a trust, and that money is kept outside of your estate. So if people are slightly older, so in this scenario here, the couple are 55 years old, the premiums are going to be a little bit more expensive, £138.66, but your life expectancy still needs to get to 115 before you've paid in £100,000. For 65s, again, it still works. The numbers works, £197.76, and you have to live to 107. And if you're 75, then yes, the premiums are going to be higher, £306.18, because all of this stuff is based on the risk. So the closer you are, or the older you are, then the more likely you are to this point where this policy will need to pay out. So therefore, the insurance companies is going to charge you a higher amount, but you still need to live to 100 and 102. So it's a very good way of providing a lump sum. It's a very good way you can do it without any investment risk, because the money is not tied to any investments. The money doesn't go up and down. You can budget, and in the future, if the premiums are not, it's not comfortable for you to pay, then your children can take over the premiums. So here, what we're going to now look at is we're going to have a look at the use of trust, what they are, how they work, and why they're very, very effective from an inheritance tax planning point of view. So the first thing is, a trust is a legal arrangement. It allows a third party, i.e. a trustee, to hold assets on behalf of a beneficiary or beneficiaries. So, for example, you could set up a trust. Your children could be the trustees and the beneficiaries. Your children could be the trustees, and it could be for your grandchildren as the beneficiaries. So you've got options there. The good thing is it allows you to transfer wealth from generation to generation. So trusts have been around for a long time. A lot of people have used trust-based planning to improve the overall efficiency of their overall planning. So key thing is you can use the money to transfer wealth. You can pass it on from generation to generation. Certainly that's really, really attractive. The other thing is the problem I mentioned previously about the inheritance tax at 64% or £640,000 going to a taxman. By setting up a trust, you're avoiding that scenario where if the second generation passed away 5 years, just 5 years after the first generation, you're avoiding that problem. So again, really, really important. It can also allow you to make sure that you can retain control, and it provides significant protection to the beneficiaries. So for example, if the beneficiaries are going through a tricky situation in terms of divorce, then the money in a discretionary trust is being protected. Absolutely important. No one else can get access to that money. And it also protects the money in the event of bankruptcy. So if you have a business, the business fails, then the trust will protect it. Now, where a trust can be challenged is, let's say, for example, you're setting up the money, you're putting the money into a trust just before one of these events happen, then the trustees or the people involved in the bankruptcy or the in a divorce situation, they would certainly be interested. So you can't do it in that type of scenario. So what we're going to now look at is 3 different types of plans that we can use in terms of helping you with your inheritance tax planning. So the first one is what we call the gift plan. The investment will be outside of your estate for inheritance tax purposes, as long as you survive 7 years. So whenever you're giving anything away, there's always a 7-year rule. The annual allowances will be immediately outside of your estate for inheritance tax purposes. So every year, if you wanted to do, you could top up £3,000 into your gift plan, give it away, get it outside of your estate, utilize your allowances. The key thing is any growth in the investment is immediately outside of your estate for inheritance tax purposes. So let's say you've put in £100,000 into this gift plan. Over a period of time, the value of the investment grows to £150,000. Then after 7 years, the whole £100,000 will be outside of your estate, but the growth is immediately outside of your estate because it belongs to the trust. So that's really important. Withdrawals are allowed within the allowance, and they can be paid without an immediate liability to income tax. And at St. James's Place, when we set up the trust, when we set up the investment, we set up the trust at the same time, and there's no additional cost to you for setting up that trust. So key things are, in terms of the uses, it allows you to make maximum use of inheritance tax exemptions and reliefs. So that's really, really good. It allows you to think about, okay, you want to help your children or your grandchildren, and you're thinking about school fees or university fees. From your point of view, it will allow you to get this money out of the estate. It will allow protection, and you can provide this money to your grandchildren. So therefore, you're using the trust to pass on the asset from generation to generation. And it will ensure that your beneficiaries can receive the money if they needed the money quickly at the point of your death without any further complications. And the key thing is, when we're using a discretionary trust, the money in the discretionary trust will never form part of the beneficiary's estate from an inheritance tax point of view. So the more you can put into a trust, the more money is going to be protected, the more that will be able to pass down from generation to generation. And that's one of the keys with regards to inheritance tax planning. So what we're looking now at is the discounted gift plan. So the key benefits of this plan are, it allows an immediate reduction in your potential inheritance tax liability where eligible. Any income so it allow you to provide an income. So this is a really great solution where you've got the capital, you need access to the income, because or you need access to the income, and it doesn't, it's not affected, it doesn't break the gift with reservation rules. So this particular product will give you a maximum of 4% that you can take out every year as income, but because it's really a withdrawal from the bond, you're not subject to income tax on this money. It's a return of it's treated as a return of capital. So now what will happen is, with this bond, the money is being invested. So as long as the money is growing at a rate of more than 4%, your funds will continue to increase in value even after the withdrawals. And if your funds are growing at a rate of less than 4%, then what that means is the value of your fund will be decreasing. And the good thing with this type of policy is that, again, after 7 years, the whole of this investment will be outside of your estate. So the discounted gift plan. So again, we're saying that the future growth is going to be immediately outside of your estate from inheritance tax. So with this product, some of it will be immediately outside, some will be outside after 7 years, and I'll go through an example just to cover that with you. And of course, there are potential immediate tax savings, which we'll have a look at on this table. So in this scenario, we're looking at £250,000 being given away into this discounted gift plan. So you could make the gift at the age of 60. The value of the discount would be £138,000. What that means is, by doing this gift at age 60, £250,000, it's going to save you £55,200 straight away. And the balance of this money will be outside of your estate after 7 years. If you're a little bit older, i.e. 70 years old, you're putting in £250,000, then £108,000 will be the value of the discount at 40%, which means £43,000 will be outside. If you're a little bit older, then you can see that the value of the discount is going down. Your tax savings are going down, but nonetheless, it's still a very valuable, very useful form of planning, which allows you to give the money away, retain access to income, and get the benefit of this immediate reduction in your inheritance tax. So that's really good about this type of plan. The next plan we need to consider is a loan plan. So this is slightly different to the first two, the gift plan and the discounted gift plan, because in those two, it requires you to give away your capital. Now, this one is where the loan plan is more suitable, where you're not 100% sure that you can afford to give away your income or your asset. Certainly, this will allow you to still be able to access that money. So when you're giving this money away, the money is still in your estate, but as you take the money out, the money will be reduced out, and you take it out and spend it, it will be reduced from your estate. So it can help you to reduce your inheritance tax liability. So how we look at this one is, really, you've got this sum of money, £100,000, you've given it away into a loan plan, you've got access to the money the £100,000 is still in your estate for inheritance tax purposes. But as that money comes down, as you take it out, you use it, your liability is coming down. So what it allows you to do, keep access to it, but any growth that will not be attached to you, that will belong to a trust, and therefore will be outside of your estate as well. And the key thing is you've got access to this money. So if your circumstances change, again, it's really useful to have this as well. Loan plan continued. Again, like the other ones, investment growth is going to be outside of your estate. You have the ability to reclaim the loan at any time. There is no inheritance tax payable on establishing the trust. And the paperwork is kept to a minimum. So with all of these bonds, the paperwork is kept to a minimum in the sense that you haven't got annual self-assessment or declaration or a tax return to do. There isn't any of that stuff to do. So that's really good. So just to summarize, this allows you to cap your inheritance tax liability, gives you still access to your money. You can take loan repayments to supplement your income if required. So it's just giving you that flexibility. And then, so far we've looked at giving away the asset. So far we've looked at life policies, i.e. using a whole of life policy. That might be appropriate. We've talked about giving away some small gifts. We've talked about giving the money into a trust, i.e. larger amounts. Now, when you're giving the money into a trust, we might recommend that you also combine it with a 7-year policy. And the idea there is that if you're giving assets away, your liability is for 7 years. So why not cover the liability on the tax if you were to pass away within 7 years? So that really just makes sure that your planning is as efficient, as effective as possible, just in case something happens and you pass away within 7 years. Now, we've talked about life solutions, life policies, we've talked about giving the money into a trust, but there might be some scenarios where you might not actually be able to give away the assets, or you might still need, you might need access to it. And what we have, or maybe you can't get life insurance because age is too high or health is not good, or just the premiums might be prohibitive, depending on various factors. Now, the good thing is with this enterprise investment scheme, you can get income tax relief of 30%. So on any tax that you've paid, so that could be rental income, PAYE, income, i.e. from employment, dividends, you can claim back 30%. So a simple example, you put in £10,000 into this. As long as you've paid £3,000 of tax, you're able to claim this £3,000 back as well. You also get capital gains tax deferral. So if you've sold an asset in the last 3 years, or you're planning on selling an asset within the next 12 months, then you can use this to defer your capital gains tax. Now, as long as you always stay in this type of product, an enterprise investment scheme, then you can keep deferring it until the point of death. At that point, capital gains tax would get wiped out. So again, it's an efficient structure. And the key thing is inheritance tax savings after 3 years may be achieved using an enterprise investment scheme. So again, there are multiple tax advantages, but before you do this sort of planning, I would advise that yes, it is higher risk. It's not going to be suitable for everyone. So if you've never done investments before, then clearly this sort of investment is not going to be suitable for everyone. For clients that have done investments before, they've got investment experience, this may be suitable for them. Now, what I would say is, although it gives you various tax advantages, which are important, we have to also make sure that you're comfortable and you understand the risks involved. If you're not comfortable with the risks of this type of product, then this product may not be suitable for you. So we're also now looking at another type of planning. So in the enterprise investment scheme, these are companies that the government is keen to encourage investment into these types of companies. Moving on to another type of planning you can do where we're looking to invest the money, you're looking to benefit from business relief, which applies on assets, certain qualifying assets. And the key thing is with this is that as long as you survive 2 years from the time of giving the gift, from time of making this investment, then this is going to be outside of your estate. If you've got access to the money, if you need it, it's there. You're not giving anything away. You're not paying, you're not using a life policy. It's just a planning that works within 2 years. It's particularly suitable where clients are elderly, they don't want to give the assets away, can't get life policies, etc. Now, with this type of planning, the key thing is if there's a husband and wife, let's say one of them passes away, the first one passes away after 1 year of doing the investment. As long as the second person survives one further year, i.e. they make up the 2 years between them, then that's going to be outside of their estate from a inheritance tax point of view. Now, what this is showing you here is the chance of surviving 2 years and a chance of surviving 7 years. So when you get to age 80, you've still got a very good chance that you will survive 2 years, whereas the chance of surviving 7 years is actually less. If you're 85 or 90, you've still got a very good chance that you will survive 2 years, but less so that you will survive seven years. So the key thing with this business relief is you've got to hold it for 2 years, plus you've got to hold the qualifying shares at the point of death. So as long as you meet those two criteria, those two conditions, then you will benefit from business relief on investments. Main residence property planning. So this is one that I come across plenty of times at meetings. Now, a lot of clients just say, well, I'll just give my residential property away. I'll carry on living in the property and my inheritance tax planning is solved. Unfortunately, it's never that easy, never that straightforward. Where clients have done this, the problem with this sort of planning is you only find out when it's actually too late, i.e. when the people have passed away. Now, in this planning, there's essentially two types of scenarios we need to consider. The first scenario is you give a share of the property away, the children live with you. That's absolutely fine. So from the moment you give it away, as long as the children continue, you share the running costs of the house, that's fine. Now, the date of the gift is from when you gave it away and when the children started paying their share of the bills. So if you gave the share of the property away 5 years ago, but the children haven't started paying until this year, then really it's only going to start from this year in terms of this scenario. So that's the first scenario, and that might be attractive to some people where they're going to carry on living together, but then you have to also consider that things can and things will change in the future. So in scenario one, everyone was living together, that was the plan. But in scenario two, you've given the property away, children don't live with you anymore. So you gave the shares away whilst you were either living together or when the children were not living with you. Now, because you've given away shares of this property, i.e. of your property to your children, now if you carry on living in this property, you've got to pay the children a market share of the rent, i.e. a market equivalent value of the rent. So if the rental for that type of property is £2,000 and you've given away 50%, then you've got to pay this rental income to your children. Now, the problem with this is that this is money that the children are going to receive, so it's going to be taxable just like any other rental income. So you've got to have the money, the children need to pay tax on it. And also the other problem with both of these scenarios is when you're giving away a share in the property, apart from the issues that I mentioned so far, you have to also consider that you're actually diluting your position. You're weakening your situation. So by doing that, that means that if there was, for example, you've given it to your children, there's a divorce, then there's going to be a loss of value because of the divorce. So again, you've got to be careful. Although it might seem straightforward, that you have to also consider all the different types of risks involved with this type of planning. So this brings us now onto inheritance tax, where we try and summarize your key options that I've discussed so far. So first option is you can put the money into a trust. The second option is you can look at whole of life insurance. You can look at life cover to age 90 if you know you're going to give away the assets by age 83, absolutely fine. Or you could look at 7-year policies to match the gift, because we're looking at different solutions which are most effective for that set of circumstances. You can look at tax efficient investments. So for example, business relief, enterprise investment schemes, which I've mentioned so far. And the fourth one, which is probably always the most difficult one, is spend or give your money away. A lot of times it's actually difficult. It is difficult. The bulk of the asset, the bulk of the estate is always going to be tied up. There's going to be a significant part in property. Property usually is the largest part of the estate, and property and asset prices will continue to increase. So even though you may give some away, the fact is if the asset prices continue to increase, then you'll end up needing to give more away. So just need to consider these different options. So in summary, we said we'd look at the concerns that a lot of people mentioned. So hopefully you've seen how these concerns could be relevant to your situation in terms of your types of planning and why you should be thinking about this from as soon as possible. We talked about some initial planning ideas, i.e. ISAs are not tax efficient from a inheritance tax point of view. Absolutely fine from a capital gains income tax point of view, but ISAs will form part of the estate. We mentioned that the returns you're getting on these cash ISAs are very low, and the rate of inheritance tax is 40%. So clearly, it doesn't make sense to have a lot of this money in ISAs earning very minimal returns. We should also consider pensions as a very tax efficient opportunity, and also different gifting allowances, exemptions that you should certainly try and utilize on a regular basis, because if you don't use them, you will lose those valuable allowances. So we spoke about the nil rate bands, 325 for an individual, 650 for a couple, and the main residence nil rate band, which brings it up to 500 for an individual, or £1 million for a couple. We spoke about the assets, where assets are over £2 million, then the main residence nil rate band will get affected. We also spoke about the inheritance tax at 64%, where the second generation passes away just 5 years after the first generation, and you end up paying a lot of tax. Of course, we've talked about gifting, giving away assets, try and make use of the 7-year taper. So what we're saying is try and give the assets away as soon as possible to reduce your estate and to improve your chances of surviving the 7 years. The longer you leave it, the harder it becomes. And the same thing applies to all of these things. The longer you leave all of these things, the harder it is. Wills and lasting power of attorney, I said everyone should really just have them or review your existing arrangements. You should have a look at the different types of trusts available according to your situation, or it may be a combination of different trusts, and also how we can use life insurance as a really good way to cover the tax due on gifts within 7 years, or go up to age 90 if you're going to give the assets away, if that's your plan. Or if you think, well, I can't really afford to give away the assets, then whole of life is a very, very good solution. We talked about enterprise investment scheme, business relief. They are higher risk investments, therefore not suitable for all. Main residence property planning, we've looked at the options available there. So there's just a quick question for you to think about here. A couple had 10 properties during their lifetime. During this time, they've been building up their property portfolio over many years, looking after each one, maintaining it, insuring against loss, paying the mortgages off over 25 years, collecting rent, dealing with any problems. So we're doing quite a lot of work. Now, upon final death, why did their loved ones end up with only 6 properties? Who were they looking after 4 of the properties for? And what did the beneficiaries question at the end? So in terms of the answers, the first one is 4 properties or 40% has gone to the taxman. Who were you looking after? Well, you were actually just holding these in trust for the benefit of the taxman. You were doing all of this work, gathering all the rents, and looking after it for the taxman. And the key thing is make sure that things have been set up in the correct way and that you're reviewing these things on a regular basis. So that brings us to question and answer. Thank you for listening to the presentation. I hope you enjoyed it. And I'll also put my contact details up. So let's stop share.
Dipesh bhai,
Hello, Purnimaben.
And there are quite a few questions on the chat.
Okay.
Do you want to address them now? If
Yeah,
I read
so-
out the question to you,
Yeah, if you could read the question.
the first one is, can you explain tax avoidance and planning for single people? Can you incorporate trusts within a will to avoid taxes for single people?
So a couple of questions. So tax avoidance and tax planning. So tax avoidance is where you're taking deliberate steps to deprive the revenue of taxation, whereas tax planning is totally different. So everything that I've discussed so far is totally within the rules. We're talking about the allowances. The revenue do actually give you quite a good range of allowances, exemptions that you should certainly try and utilize. Now, it is possible to put assets into a trust via the will. That would provide some security, some protection on the assets. So certainly it could be considered. Now, whether it's a single person or a couple, everyone should be thinking about their planning.
Second question is, person who does not have UK tax file and supported himself and family from his capital, does he or she need a UK tax file?
I'm not sure what they mean by a tax file. Do they live in the UK?
I don't know. The question is from Sobhag Shah. Is there any way we can unmute Sobhag by, if we can see him, to elaborate on his question, please? Zoom team.
I'm here, I'm living in this country since last almost 30 years, and I have used my savings, capital income, and income from capital, and income I have used only allowable. So all the income I have used now, and I'm surviving on capital. I do not have income tax file because I never work in this country, and I never earn more than allowable tax allowable. So for inheritance tax, do I need a tax file?
So this will depend on the value of the assets. So if you're married, then the value of the allowance is £1 million. So if you've got assets over £1 million between you and your wife, then there will be inheritance tax payable.
I understand. Only I'm asking whether do I need that income tax file?
No, because it's a totally different tax. This is based on your assets minus your liabilities.
Okay. Thank you.
Thank you. The next question is, up to what age can you put money in your pension?
So 75 is the maximum age. So we have a lot of clients where if they're, let's say they're 60 years old, 60, 65, they're still working, then again, it makes sense to put the maximum money into the pension because of the tax relief. And whilst you've got earnings, you can put in a good amount. If you're retired and you've got no earnings, so for example, things like rental income, you can't include as earnings. It has to be employment earnings. So if you're retired and you've got no income, then you can put in a maximum of 2,880. The government will top it up by £720 to make it 3,600. Of course, if you're a limited company where you're taking just a small salary, then the limited company can put in a larger contribution on your behalf.
Thank you. The next question is, I think, in relation to the illustration that you had shown on one of your slides, Dipesh Bhai. The question is, if the second generation receives 600K out of the 1 million, given they are couple, does the NRB not apply? That is the 650K. So the third generation does not pay that much tax in the end.
So what we're assuming is that the first generation had assets up to the nil rate band. The second generation have done well. They've got assets up to the nil rate band. And the third generation have also got assets up to a nil rate band. So what we're saying is where their allowances have already been used up elsewhere and they receive this money, then that's where you get the situation of tax on tax. If they don't have any allowances. If they have allowances, then this problem is slightly different.
Okay, thank you. The next question is, if transfers are made out of income, do they form part gifts in the 7-year rule, or are they exempt?
So let's say,
shall I carry on because there's a couple more? Also define what are regular gifts out of income. Does it have to be out of monthly, or can it be out of annual surplus? Quite a few questions in there.
well, quite a few questions in one. So let's try and deal with those 3 questions. So first of all, surplus income. So let's say, for example, your surplus income per month is £2,000. You can give that away, no problems. Income can be from any sources that you've paid tax on. That's surplus income that we're talking about. So, for example, any rental income you receive, any employment income, pension income, that money is the money that you can give away. Did I cover the whole question, or have I missed something?
Now, I think the whole question was, if transfers are made out of income, do they form part of gifts in the year 7 rule?
No,
Or
income is immediately outside of your estate.
Also define what are regular gifts out of income. I think you covered that, haven't you?
Yep.
Does it have to be out of monthly, or can it be out of annual surplus?
Usually it's better to give it away each month as the income arises.
Okay, thank you. We move on to the next question, which is, would it be idle to put the money into a pension scheme and nominate the pension fund to your beneficiaries, or so that no inheritance tax till the age of 75?
It's always worth putting money into a pension scheme. If you pass away after the age of 75, then it's not it's subject to income tax, not inheritance tax. So yeah, absolutely worthwhile, because any money in a pension is going to be outside of your estate as well from an inheritance tax point of view.
Okay, thank you. The next one is, if the gift given by couple jointly and one person dies in 3 years and the other partner survives more than 7 years, how inheritance tax will apply to gift?
So each person is making their own individual gift. Therefore, each person will need to survive their own 7 years. In this scenario, where one person survives 7 years, there won't be any inheritance tax, and the other person who only survived 3 years, there will be tax.
Okay. The next one is, if you cover your inheritance tax liability with life insurance, is life insurance subject to inheritance tax liability?
No, because we always write the life policies into trust, and that means the proceeds will never form part of your estate.
Okay, so that would be exempt from inheritance tax.
Correct.
Okay, the next question is, to have your will written, who should you go to, will writers or solicitors?
So usually we would recommend solicitors, just because when a solicitor writes the will, it's a little bit more, they've got, well, they have to go through a more stringent process than maybe someone who's just done a will writing course.
Okay, thank you. Next one is, does all wills are registered at centralized body?
No, they're not registered at a centralized body now.
So they don't, any wills written do not need to be registered at all, or?
No, you would normally keep a copy with you. The solicitors would have one, and you'd make your family members aware of where the will is.
Okay, what is the cost for setting up a trust for grandchildren's university fees?
So for the trust that we set up, there's no cost for setting up the trust. When we do the investment, we do the trust, we do everything at the same time. So we don't charge any separate fees for setting up a trust.
Okay, so no fees for setting up the trust, but does that mean that the fees you would incur a fee later on in the process?
So the fees are tied to the product, and as part of the product, we set up the trust. We have all the paperwork. We make sure it's all set up correctly, but there isn't a separate cost for setting up a trust.
Okay. Can you nominate your sons as trustee? Inheritance tax can they transfer to their children after 7 years?
Can you nominate your sons as a trustee, and the money's in the trust? Well, if the money's in the trust, then they don't have to transfer it to their children, because a discretionary trust will allow for children, grandchildren, great grandchildren to be the beneficiaries of the assets within the discretionary trust.
So it will all be part of the process of the trust.
Yeah, the trust can go on for a long time.
Okay. Next one is, does your private pension always get sheltered from inheritance tax?
Sorry.
Does your private pension always get sheltered from inheritance tax? Does it not fall part of the estate?
No, as long as the money stays in a pension or a dependent's drawdown pension, then that means there's not going to be in your estate for inheritance tax purposes.
Okay, thank you. What is the annual cost of maintaining a trust for? No, I'm sorry, I've taken that one. When the life insurance policy is written in a trust, when the funds go to trust, will the beneficiary pay any taxes on getting money from the trust?
No.
So no fees on releasing the money from the trust? Is that what it means?
No fees. The money, there's no tax to get that money out of a life policy. The whole reason why you put the life policy in trust is to protect it from tax. If you don't put it into a trust, then it will be subject to tax.
Okay. Same rules apply if your children and grandchildren are living abroad?
Yeah, for the proceeds of a life policy, it shouldn't make any difference where somebody lives.
Okay, but this life policy should have been taken out in this country though, or does it not matter?
Yeah, if the person lives in the UK, generally the life policy will be taken out in the UK.
Sure.
If you live in India or Kenya, then a UK life policy would not really be suitable, because the risks are different, and it has to be done on a country by country. So if you're living in India, you should probably get a life policy in India.
But if you take out a life policy in this country, your beneficiaries could be living anywhere abroad.
That's absolutely fine. That's absolutely fine, yeah.
Okay. Some advice on maturing pension fund, i.e. drawdown or pension. If taking pension, check on the open market or stay with the provider for best rates.
So it depends on what you're trying to do. If, for example, you need the security of a fixed income, then you're looking at a annuity type scenario, where sometimes you'll get better rates from the provider, or you'll have to check. But if your plan is you're not doing it because you need a fixed amount of income, i.e. you've got other income, you've got other assets, then you'd be looking at possibly a drawdown, because the annuity rates are very, very low at the moment, because they're linked to interest rates and yield curves and other things like that, where the rates are very low. Now, the problem is, once you go into an annuity, you can't change your mind, you can't come out of it. And when you pass away, you're not able to leave any money to your family members.
Okay. The next one is, you have not mentioned AIM, inheritance tax, as an option. This option takes money out of your estate after 2 years.
That's business relief. Business relief investments will cover AIM investments as well.
Okay.
They're qualifying businesses.
So it's a different type of.
Yeah, it's all under business relief. AIM is covered under that.
Okay. Are properties abroad, say in India, also form part of inheritance tax?
If you've been in the UK for more than 15 years, all assets on a worldwide basis will form part of your inheritance tax.
So if you've been in the UK for more than 15 years.
Correct.
Probably apply to most of us.
Most, yeah.
Okay, the next one is, if you have time, can you please cover assets across UK and India too for inheritance tax if different? I think we've just answered that question, haven't we? Unless you want to say a few more words on it.
No, I mean the key thing is it will come down to your domicile. So if you've been living in the UK for more than 15 years, you'll be deemed domiciled for inheritance tax purposes. That means all assets, UK worldwide assets, will get captured in your total estate, and it will be subject to inheritance tax at 40%.
Okay. Next one is nil rate for couple is 650,000. How does it go to 1 million? Can you please explain this again?
Yeah, sure. So everyone has the standard nil rate band, 325,000, 325,000. That's 650. If you add another 175 plus 175 or 350 to the 650, that's where the million comes from. So it's the nil rate band plus the main residence nil rate band that gives you a total of 1 million.
Okay. HMRC expects a couple to live on £26,000 per year. Anything over can be given away if you do not need the money. I don't know whether that's a question or just a statement.
I'm not sure whether that's a question or a statement. Ultimately, you can always give away your surplus income. I'm not sure about that £26,000, what impact that has. Ultimately, if you've got surplus income, you can give it away. If you haven't, then you can't. Otherwise, it's treated as giving away your capital.
Okay, there's a request for your contact number, which I'm sure you will put up on the screen after we finish the question and answers, or do you want to do it now?
Yeah, I can put my contact details on. I'll put it into the chat box now.
Okay, the next question is, so Dipesh Bhai is putting his contact number and details on the chat box. If anybody is interested, please keep an eye on the chat box. Okay, the next question is, are there any investments one can make which are completely exempt from inheritance tax?
No, everything has a qualifying time, 2 years or 7 years. Nothing which is completely exempt from inheritance tax on day one.
Okay, there's a request to recommend a will writer's contact details. If you have any, can you recommend a will writer's?
Yeah, if they can drop me an email, then I can put the contact details for a will writer.
Okay. Can we have the slide of your details for contact? Okay, that's been done. What takes priority, LPA or wills?
There are two separate documents. So the LPA is a document to do with whilst you're alive if you lose mental capacity due to accident or illness. And the will is what happens to assets when you pass away. So two totally separate documents. The LPA is not in the will, or the will is not in the LPA, just two separate documents as well. And they deal with different things. So one works whilst you're alive, one works when you've passed away.
Okay. Are trusts revocable?
Yes, trust can be revocable if it's a discretionary trust.
Okay. Next one is, would your own house be counted for inheritance tax?
Yes.
Yes. Yes. How does protecting property trust work? Is that advisable for us?
It depends what you mean by a property trust. So we come across these; they come under different, slightly different names. We a lot of times we don't think they're as good as they're made out to be, just purely because you're using up your new residence band allowance, and we don't think that's suitable.
Okay, and the last question I think is, does not LPA lapse when you die?
You wouldn't need it. LPA is only to do with if you lose mental capacity, i.e., someone else is there to make decisions, only relevant whilst you're alive.
Okay. Thank you very much, Dipesh Pai, for that very, very informative and exhaustive questions, which you have answered very well. I'm sure everybody will agree that they have been very, very useful to them. Unless you have anything more to say, we'll probably proceed further with the event.
Nothing more for me to say. Just thank you to the committee. Thank you for everyone for organising, and thank you to everyone for attending. And I hope you found it enjoyable. If there's anything you want to discuss further, then please feel free to get in touch. Might be just a quick telephone call or an email, whatever feels comfortable for you.
Thank you very much, Dipesh Pai. We can now zoom in on Bhairavi for vote of thanks, please.
Jai Jinendra and Jai Shri Krishna to everyone. My name is Bhairavi Shah and I am an executive committee member of Namnatwani Bhagini Samaj. Thank you very much, Dipesh Bhai. The talk was very informative and you have explained its benefits and importance. In today's uncertain and unpredictable pandemic time, no one knows what's waiting around the corner. Many families are left behind with the huge debts due to lack of the future planning, such as funeral plans and wills. Today's talk by Dipesh Bhai has made us aware how our assets can be safeguarded against inheritance tax, which is considered inherently unfair. I hope all the viewers will give future planning a priority in securing their assets for families. On behalf of Namnatwani Bhagini Samaj, I would like to thank Dipesh Bhai for sharing his valuable knowledge with us and bring awareness. Last but not the least, thank you very much to Arvind Bhai and his Zoom team. Jai Jinendra and Jai Shri Krishna to all. Thank you.